Hi, AP students. We're giving you a chance to get some review here for the AP test and some practice on, um, some of these free response questions that really, to be honest with you, um, kind of cover every single concept that we've gone through. So some of them are a little more challenging than others. We're starting with a pretty challenging one that we um, kind of got to cover just about everything. So anyway, my advice would be take a picture of the screen, solve everything out, take yourself, you're given about, they say on average for a question like this is the number one question. They say that you're going to have about, if you kind of space your time out equally between the big long one and two short ones, about a half hour to do it. Okay, so probably take about 10 minutes to read it, 15 maybe or so minutes to answer it. Let's see if you can come up with, what you're going to do. Okay. Now, I will give you a quick tip before you get started that we have some information here that our economy is in a recession. So if I were you, I would simply draw that recession graph because 9 times out of 10, we're going to have to come back to that anyway. You don't need it right away, but like I said, 9 times out of 10, you're going to have to come back to that. And it's a good reference point too, and we're getting good at drawing these things. So it won't hurt you to have it. Okay, my sloppy graph there. All right, pause the video. Go ahead and figure this stuff out. Take a guess. I'll answer them all in order. So if you're stuck somewhere and you want to make sure you're right, by all means you can go along with the video. Okay, pause it. Let's see what you come up with. Okay, so I had my previous graph on, and I'm gonna do the best I can to kind of draw this for you guys on here. It won't be perfect. But either way, for part A, it's asking us to draw a Phillips curve um, based on this recession. Okay, so I'm going to draw my little graph back over here. Forgive me for not labeling, just to not waste your time. All right. Now, my real GDP, okay, remember, also can represent my employment rate. Okay, so here's our full employment rate. So we can draw that on our Phillips curve. I am going to label my Phillips curve. Here's unemployment down here. Here's inflation up here. This is what my short run looks like, and my long run looks like this. Okay, now remember, my long run Phillips curve never moves. My long run Phillips curve also represents this full employment, this full output that we are looking at. Now, what we know is for employment along this axis here, our employment is down, which means our unemployment is going to have to go up, right? So we know our unemployment has increased due to this going this way. And we also know that if we were in long run equilibrium, our aggregate demand would be right here. Well, that has made our price level go down. So we are in this particular point. We're going to be somewhere to the right of our long run Phillips curve. It says to label that spot with an X. Okay. So that's what your Phillips curve should look like. We're moving forward to part B here. And it says assume the government increases its deficit spending to restore full employment. So it's trying to increase aggregate demand. All right. What's that going to do on interest rates in Canada? So again, we know we're in a recession. We're trying to increase aggregate demand over here, but it's asking us for what's that going to do to interest rates? So we've got to get our loanable funds. And it doesn't really tell you that. You just got to know that when the government increases its deficit spending, that it has to borrow more money. Okay, so when the government borrows more money, we're going to see an increase in demand. And our interest rates are going to increase. All right. And as you explain, I kind of explained it in words. I'm not going to write it on there for you. Bottom line is the government has to borrow more money, which increases the demand, which raises interest rates. All right. Now, part C, it's asking what's going to happen to financial capital flows in Canada. So financial capital is going to be investments. Those investments can be put in all sorts of things: banks, stock market, property. Well, what we know is that interest rates in banks are going to increase. And so that's going to lead to some people investing in Canadian banks. So they're going to start saving money in Canadian banks. So capital flows are going to increase due to higher interest rates. Okay, moving on to D, and I'm going to go on to the next slide here. Okay, sorry, I need to make another blank one. Going on to D, it is asking us what's going to happen to the Canadian dollar. Okay, so it's talking about Canada and Norway being trading partners. I'm going to go ahead and draw, and I'm going to make this one a little bit bigger so it's easier for me to draw. I'm going to draw the Canadian dollar, right? And so how I label this, remember, I got Norway, the krone over the Canadian dollar, CAD. I always label this so I can kind of keep track. I know what's going on like this. I just put fractions in there. That means I can get 2 Norway dollars for 1 Canadian dollar. This means it's 1 to 1. And this means it costs me 2 Canadian dollars. I'm matching it up with this fraction thing up here, right? 2 Canadian dollars for 1 Norway dollar. So this line here is my demand by Norway. And this is my supply by Canada. All right. And I'm going to throw in here too, I'm just going to guess that later on that we're going to need Norway as well. We're flipping things. Demand by Canada, supply by Norway, and then we flip our fractions over here. All right. So it's asking us what's happening now that, remember, we had part C, we said we're going to have more capital flows to Canada. Okay. So those more capital flows, financial capital flows, sorry, means that we need to buy Canadian dollars. So Norway is going to send money, well, basically send for Canadian dollars. The demand for Canadian dollars by Norway is going to increase. Now, you could also wrap it around and say that Canada is going to demand less Norwegian dollar or Norwegian crones, and that's going to flip things over here. It's going to give you the same answer. Okay, so you could do either or. I'm going to stick with one and keep it kind of simple. Remember, when we increase our demand by Norway, we increase the supply over here by Norway for their currency. All right, so over here we have the Canadian dollar appreciating, and we have the Norwegian krone depreciating. They've got to be the opposite. Okay, let's make sure we answered everything on there. Okay, so we've got everything that will work. Like I said, you could also have drawn a flip because, again, Canada would be stop demanding Norwegian dollars because they want to invest in their own economy in that particular case. All right. Part E gives us, it asks us, again, we kind of got ahead of ourselves, which is good. What happens to the Norwegian krone is going to depreciate. Part F gets us into this capital flows account. Now, it's given us the situation or part of the, it's given us part of the answer. And I'm going to just set up our little chart here. So we've got Canada, we've got Norway, and we've got capital, or sorry, current account. That's goods and services, right? Imports and exports. And we've got our financial account. Well, here's what we know. We know that our financial account, Norway is sending money into Canada. So their inflows are greater than outflows. And if we can solve that box right there, we can solve the rest. So if we know that, then we also know that the Norway's outflows are greater than inflows. And keeping X's and O's together, we know that Norway's exports are greater than their imports. and Canada's imports are greater than their exports. Okay, keeping these inequality signs together, keeping the X's and O's together, we can figure that out. Now, that's not that's not the answer. It asks us, what is Norway's current account uh, in? Deficit, surplus, or is it staying the same? Well, their current account exports are greater than imports. That means they're getting more money in. So your answer is surplus due to negative inflows or positive outflows, however you put it. Okay, so that's your answer for part F. Again, we're tying this in. All right, last but not least, and this is I'm sorry, part G is not, we are not at the last part. I got to make another page. All right, so part G is asking us to tie in, due to the Canadian currency appreciating, what happens to, well, eventually we're going to get into aggregate demand, but what happens on Canada's net exports? So remember, when we have an increase in the value of our currency, going back to our original graph up here, okay, this is for Canada again. When we have a increase in the value of our currency, it appreciates. That means other countries can't afford it. Okay, so the value in the Canadian dollar is going to cause a decrease in aggregate demand. Okay, that's what it's asking. Now, it didn't have you draw this graph. Okay, it's just asking you what effect will the change be, and you've got to know that it's a decrease. You got a 50-50 shot at getting that right. Last but not least, it's asking us to go back to our original Phillips curve, which I'm just going to draw real quick. If you remember, okay, we had point X right here. Okay, so point X represented our original graph up here from that we didn't really need to draw, but we drew so we could reference it. Well, this decrease in demand, remember, is going to cause us to make our employment go down, which means our unemployment needs to increase more, and our price level goes down further too. So your new Phillips curve should look something like this. They have you label it with a Z. Okay, whole lot thrown at you there. Okay, don't feel discouraged if you're missing it. This is obviously some tricky stuff, and you're keeping a lot of things straight. Keep practicing. You'll keep getting better, and we'll get you there.